The 4 ways a Roth IRA can't help you. Now, you know how much I love the Roth IRA, and everyone should have it, and I think it can help basically everyone, but there are 4 key components to the Roth which will not give you any advantages whatsoever over the traditional IRA or 401k. And it pains me to say it, but there is 4 reasons not to do the Roth, which we'll talk about here today. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place where you come to learn all about tax planning, retirement planning, estate planning, financial planning, the whole kit and caboodle when it comes to financial planning. So I appreciate you being here. As always, if you like what you see here, don't forget to subscribe down below. There's a little tiny red button on the bottom right side of the screen. Probably you'll see it right now. Hit that little button and subscribe, and then don't forget to hit the bell for future notifications. So let's dive right in it. This could be the last book where I say I throw a couple bones for the disbelievers, all right? And here's this. So this, again, let me show you my book, The Tax Bomb in Your Retirement Accounts and How the Roth IRA Helps You Avoid It. And that's it, available right now on Amazon.com, Kindle Unlimited for free. The regular Kindle, $4.49. And if you want the paperback, it's $5.99. And I'd be stunned if you don't save $5.99 on that puppy. And I'll put the link in the show notes how to get it. All right, but there is a couple reasons that I wanted to share with you about the Roth IRA and when it won't help you at all as compared to a traditional IRA. So let's get right into it. The first one, and I actually think this is a big deal. Roth IRAs are included in your estate tax. All right. Now, we're talking how the Roth IRA won't give you any better benefits than a traditional IRA. Both of these things are included in your estate tax. And Roth IRAs are included in your estate tax for estate tax purposes. Yes, the vast majority of Americans will die without owing any federal estate tax, but if you're one of the couple thousand Americans who have an estate over $20 million, your Roth IRA will be included. All right, so that stinks for you, but you're probably not doing that badly off after all. So just remember that. Now, with that said, everything you own, my friend, this is what gets overlooked a lot. Everything you own will be included in your estate for your estate tax purposes. Everything. So this calculator, part of my estate, my cell phone, part of my estate, everything, life insurance, part of your estate. Everyone says insurance transfers tax-free. Yes, it transfers income tax-free. It is not estate tax-free. Your home, part of your estate, everything you own that if you have ownership to it will be in your estate. Even if that means you have a living trust. But I got it in a trust, Josh. That's out of my estate, isn't it? No. If it's in a living trust, it still goes back to you under your Social Security number. Thus, you own it, and it's in your estate. Now, if it's in an irrevocable trust, or as the fancy schmancy like say, irrevocable, I just say irrevocable because you can revoke it. You can't revoke it. But it's an irrevocable trust that is not in your estate unless you just gave it to the trust on your deathbed. A lot of times they're not big fans of that. So irrevocable trust is not in your estate. And the reason it's not in your estate because you, in theory, have no ownership stake on that property you put into the trust. You are not the trustee. You're just a grantor, and you've literally made an irrevocable gift of X property to that trust. And in theory, will be included in your estate. Now, I'll tell you right now, if you think the IRS is okay, you gave an irrevocable gift and it's not going to include in your estate, you're crazy. The IRS is going to look to see who the trustee was, to see how that money ended up back to you, if at all. They're going to see if there's rules and regulations that were followed to a T to make sure that property was not really just given to the trust in name only, but you maintain ownership stake. I'm telling you, they're going to do that, and especially the states. The states are going to do that. So, all right. So Roth, though, tax-free, but it's still included in your estate for estate tax purposes. That's no big deal, Josh. We don't have anywhere near 20 million. I hear a lot of people saying, and I get that. You may not be that wealthy, but if you live in one of the states like Massachusetts or New York or Minnesota or Pennsylvania or Oregon, even Kentucky, they all have estate and or inheritance taxes, and Roth IRAs are included. A host of others have estate and inheritance tax. I'm going to go one by one on each state's estate and inheritance and or estate tax. I wanted to finish up this book first, and this is actually the last chapter. Roth IRAs will be included as part of the calculation to determine how much of your estate owes in state taxes to your estate when you pass on. Massachusetts, for instance, taxes your estate if it's greater than $1 million. Not hard to get to $1 million threshold in MA. Have a decent sized life insurance and you own a house and you're probably right there. Got that? Or guess what? In Massachusetts, you have a taxable estate. Just some life insurance or home is you're in there. They throw in your Roth IRA and is included in your estate from $1 million. In fact, Massachusetts has it. The minute you break that $1 million, you get a $1 million exemption. The minute you go 1 penny over that $1 million, it goes back to zero as if you had no exemption. It's crazy. For the love of me, I don't understand why they don't change that, but they don't. New Jersey just did. It used to be 675, and they just changed. I think it's to 2 million now. But again, New Jersey property values are pretty high. Most people work in New Jersey have a higher income per capita than they do in Mississippi, for instance. And so they're making pretty good money, which means that a lot of them have high size 401ks and whatnot. All that's included in your estate. All right, number 2. Roth IRAs are subject to creditors of non-spouse beneficiaries. And this is a big one. I think a lot of people overlook this. And again, this is not just solely to the Roth. This is to any inherited IRA. In 2014, the Supreme Court ruling unanimously, Justice Sotomayor actually wrote the thing on the Supreme Court saying that inherited IRAs are subject to creditors. So if you die and leave your IRA to a child who decides to open up a pizza shop and the pizza shop fails, his or her creditors will seek reprieve in going after your IRA, even though you're dead and you left it to your heirs. And it could be son, little Johnny there, opened up a pizza shop. And I think it was in Indiana that happened, a pizza shop in Indiana. The woman received money from her mom, used it to fund received an inherited IRA, and then she also opened a pizza shop, took on debt, couldn't pay the debt, pizza shop went kaput, and the creditors went after her inherited IRA for payment, and she said, no, that's not. It's a part of an IRA, is exempt from creditors, and the Supreme Court unanimously said, no, it's not. It was Sotomayor writing the affirmation, whatever it's called. All right, so you may want to consider other options to simply leaving your retirement accounts to a child or grandchild if you feel there's a threat of a lawsuit. Say your children are surgeons using risky cutting-edge procedures. Their malpractice premiums are through the roof. Why? Well, because they get sued all the time. And if they're getting sued all the time, the plaintiffs will look to every asset your child owns for payments, including the Roth IRA you left him or her. So just be careful and understand that while Roth IRAs are wonderful from an income tax free for heirs, they are absolutely subject to creditors for your heirs without question, as according to a 2014 Supreme Court ruling. That's just a fact. You got to realize that. So again, should I pay tax today to leave my cutting edge surgeon son, $200,000 in a Roth IRA where it could be subject to a lawsuit? Probably not. That'd be a case where you probably don't want to look at the Roth. All right, number 3. This is a big one. And again, this doesn't affect solely the Roth. It affects all IRAs. But Roths do not get a step up in basis. Now, I've talked about step up in basis in other videos, but let me just reiterate. A step up in basis, you buy a stock for $100 today. In 10 years, that stock is worth $1,000. So $100, it grows to $1,000 in 10 years. That's $900 of unrealized gain. You get hit by that daggum bus again. That same bus keeps killing you. Man, you're just rising from the dead like whatever that show, The Walking Dead, and keep coming back and boom, you're gone again. When you die, the executor or executrix, remember that's for a will, who settles it through probate, will capture the date of death valuation of all your accounts, and they'll file that. Okay, in this case, the stock was worth $1,000 on your date of death. The person you left the stock to then could sell it for $1,000 and pay no tax. So again, you bought it for $100, you died and left it at $1,000 to your little Johnny. Little Johnny then sells it the same day for $1,000. That $900 of unrealized gain is just wiped away from the map. That's a nice thing about the current tax office. Sure, step up in basis. On a side note, just remember, if you bought it for $100, Johnny inherits it for $1,000 and he sells it for $1,100. All right, so you bought it for $100, he inherits it for $1,000, then he sells it for $1,100. He does have a tax on the $100 that he gained himself on top of what's called the cost basis, which is $1,000. All right. The $900 gain escapes taxation. This is a huge benefit of the tax code, like we just said. Now, be advised, the step-up in basis rules applies to any property you own outside of a retirement account or annuity. All retirement accounts or annuity has no step-up basis. That's a big problem with all 3 accounts. IRAs, traditional Roth IRAs, and annuities. There is no step up in basis. Now, Roth doesn't matter because you don't pay tax, but still something to consider. A house, an investment property, a collectible item, anything you own that has grown in value above your initial cost will receive the step up in basis. That's just a fact. To reiterate, this means your beneficiary's basis, little Johnny, is the value of the asset on the day you die. Now, here's the problem with Roth IRAs in particular. It's very easy to identify date-of-death valuations for investment accounts. We just look at the number of shares, time the price per share, and there's our date-of-death valuation. Simple as pie. But what if the property that you leave to little Johnny is something that has no daily trade volume? In this case, your executor will want to engage an appraiser to determine the value of the property. It's very important to get appraisals done on all property. How are they going to value this calculator? And obviously, the calculator is being facetious, but let's say you have a Babe Ruth rookie card. I mean, that guy has to be valued at some point. So it's very important to get that done. And that way you can avoid potential huge tax consequence in the future if you're not actually executing the asset base, the estate right. So if you're saying, oh, the Babe Ruth rookie card is only worth 50 cents, when it's really worth $50 million, which would have given your estate an estate tax, the IRS will certainly come knocking, and they're going to come knocking to the executor and say, what's up? All right. But what does this have to do with a Roth? Well, here's where it gets unfortunate for Roth, because a Roth has no step-up basis and transfer completely tax-free to the heir without going through probate. The Roth is an easy account for the beneficiary to liquidate while waiting on the remainder of the estate to be settled. The heir may say, boy, I could really use that $50,000 to pay off that credit card debt I've accumulated. I could wait until dad's estate finally settles in 9 months, i.e. they get the appraisals done, they get the valuations, they sell the house, all that. Or I could just cash out the Roth now. After all, I already have ownership of it, because remember, a Roth does not transfer via probate. The probate court is what settles estates outside of the probate avoidance techniques with Roth, with beneficiary designations or living trusts. So anything that's in the probated won't be settled. It takes time to get settled, especially if it's real estate or an asset that's hard to value. So the kid, little Joey's saying, but this Roth IRA, well, I already got ownership of that. That's $50,000. I got those credit card people knocking on my door. I can go ahead and sell that puppy. And then when dad's house settles, I'll use that money for other things. And what do you think the heir is going to do? He's going to do just like I just said. He said, I need the money now. I don't want to wait 9 months. And I'm going to just go ahead and cash out the Roth. So what you thought you were leaving to little Johnny as a stretch IRA where he could stretch those tax-free distributions over his life, he just looked at it as, man, this is quick money, not paying tax on it. It's a wonderful account to liquidate, and you can't really blame him. And sometimes the best thing for long-term growth is actually having restrictions on when the accounts can be distributed. Annuities are famous for this with their huge surrender charges, and a lot of times that's pain, but in some ways it's not a bad thing. If you can keep people from selling stuff on the fly because there's a significant surrender charge or tax or 10% penalty like an IRA or 401k, that might actually let them avoid touching that money and let the compounding growth continue on. And I've seen that happen many times, actually. In fact, I listened to a guy, Meb Faber. He has got a wonderful investment podcast, the Meb Faber Show. And he talks about how he wished he could have some kind of investment account that says you can't touch your money for 10 years. And that way, because what we know is the vagaries of the market are such that a lot of people will want to buy in more when it's way up here than sell when it's way down here. And it should go the exact opposite. So Meb's theory is if he could avoid anyone taking a distribution from his account within 10 years, by contractual law, he could be a much better investment manager because he says, look, you got to ride this out. I'm going against the grain. That's how money is made, by being a contrarian. Unfortunately, a lot of people talk a big talk when it comes to being a contrarian, but when the really rubber hits the road, they don't want to be it. Tesla right now is a perfect example of that. I mean, look, I have no clue what I don't know, frankly, I don't care. But I know Tesla's getting knocked around some. A contrarian, and again, I'm just using that for an example. Or Apple. I remember 98, Apple's at 7. And Steve Jobs had to go begging to Bill Gates for some money. No one wanted Apple. It was worth $7 a share back then, my friends. And Steve Jobs is in front of Bill Gates on his knees begging for money. I mean, you'd have to be a serious contrarian to buy Apple at that time. Now, if you did, you were rewarded handsomely. But how many investment managers did that when they had people breathing down their neck like, why can't I get Apple? That's stupid. That stock stinks. I guarantee you, many of the same people love Apple now or whatever in its heyday. I don't even know what the price is. I guess now, because it's almost trading at $1 trillion market cap. hated Apple back in 97, 98. I guarantee. It's easy to go with the masses. There's a sheep mentality, and where you make your money is going against the masses. That's for sure. All right, so IRAs work the same way as an annuity, where they have a penalty if you take an early distribution. But once you hit 59 and a half, there is no penalty for an early distribution. And then on top of that, once you die and leave it to your heir can take it out without any muss or fuss. That's for sure. Now, secondly, because Roth does not have mandatory distributions requirements for non-spouse beneficiaries, does have mandatory distribution requirements for non-spouse beneficiaries. So remember, Roth and traditional IRA, they work the same way. I die, I leave it to my wife, Charlotte. My Charlotte does not have to take a mandatory distribution on the Roth, does not. She does have to take a mandatory distribution on her traditional IRA, but not the Roth IRA. That is what makes it wonderful, because she can just roll it to her name and she's ready to rock roll. Now, I die, I leave it to my kid. My kid has to take mandatory distributions on the Roth, just as he does on the traditional IRA. It's a non-spouse beneficiary who has to take the mandatory distributions. All right, so again, if you leave it to your spouse, no big deal. If you leave it to your heir, you're a non-spouse beneficiary, they must take mandatory distributions. So what I've seen time and again is people have these smaller IRAs, $20,000, $15,000, and the distributions, $450, something like that, something small. They're like, yeah, forget it. Let me just cash this thing out and be done with it. I've seen it happen well more than not. I just tell you, they say it's not worth the hassle. And I said, man, you can set it up where it's just automatically coming out on February 1st. You don't have to worry about it, but they just said, just give me the cash. And they're just missing the potential for, you're talking, again, multiple decades of tax-free growth. Now, again, they do have to take mandatory distributions, but those distributions are so small. Just let that sucker sit in there and grow tax-free while you're taking these tiny little distributions, but most people don't. And that's a drawback against the Roth, and particularly because A, it's tax-free, so there's no pain to the heir to take the distribution, and B, they have to do something. They have to take a distribution, so they don't want the hassle. They say, just give the whole thing to me. All right, lastly, a decedent may have the bulk of his or her assets in real estate, which is providing a decent income stream as well. The heir may be inclined to say, why should I sell the rental property, for instance, with all the costs that are associated with the listing it, commissions, got to clean up, whatnot, when I can continue to get an income from it? I'll just go ahead and liquidate the Roth, and that will give me a quick influx of the cash I could use. Again, that might actually be a good move on the person, just let that real estate property just keep, shedding income. But it does hurt the Roth again, because the Roth is immediately liquidated, and the Roth has no cost other than maybe a commission to whatever the custodian is who's managing the money. There's no taxes, no cost, no penalty. All those three things hurt the Roth in terms of long-term stretching potential. Again, stretch just simply says, I'm giving this to my kid. My kid is much younger than I, so his or her RMDs, required minimum distributions on the Roth, are low, very, very low. And because of all those three things we just said right there, it hurts the Roth and this ability to really, really be used in a stretch IRA concept. All right, so here we got the last one, bonus, and this one actually ticks me off. And this actually is straight on a Roth. It can easily get overlooked by people considering college for a youngster too, because distributions from a Roth are included in many financial aid calculations. Again, this is not exclusive to the Roth. All retirement plan distributions negatively affect financial aid. But it's important to recognize that being tax-free does not mean there are no consequences in other areas for the Roth. And here we got a group called advisors.com, and I thought this is pretty interesting. So remember, a Roth, a part of the distribution could be a tax-free return of principal. So you call up your custodian, Vanguard. This is Josh. I got $20,000 in the Roth, of which $10,000 is my own principal. The money I put in, send me a check for $10,000. They'll send you a check for $10,000. It doesn't matter how old you are. Nothing matters. Completely tax-free. But a tax-free return of contributions is reported as an untaxed income on the FAFSA, the free application for federal student aid, and other financial aid applications forms such as a CSS financial profile form. Untaxed income is added to AGI to yield total income, emphasis mine. As much as half of total income will increase the expected family contribution, the EFC. So untaxed income, i.e. I'm getting my money back. I didn't make any money. I'm just getting it back. It's not even income. It's just a return of principal. But the FAFSA and the CSS financial aid profile use that as part of your EFC, your expected family contribution. Doesn't seem right. Getting your own money back is included in income, but it is a reality when it comes to financial aid. And you have to understand the distributions from the Roth have absolute negative consequences in this. Simple fact, I'm getting my own money back without paying tax. It's going on the FAFSA. Now, I like the strategy that advisors discuss here. They say one approach is to wait until after the student graduates and to use the tax-free return of contributions then to pay down student loan debt. So what they're saying is this is what we're doing. Borrow in the first couple of years. All right. So what happens is with EFC, the expected family contributions from your FAFSA, it's usually a year or two backward looking. So when your kid's a senior in college, they're going to be looking at what you did as a sophomore, essentially. All right, so what you can do is take out, so basically when your kid's a senior in college, they're looking backwards. So when your kid is a freshman in college, they're looking at the income you made as a junior in high school for that child. So basically the 4 years of college, they're going to look at your income you had during those, 6 years previously. So again, freshman is a junior in high school, sophomore is a senior in high school, junior is a freshman in high school, senior is a sophomore in high school, and for college, if that makes sense. I know it's kind of convoluted, but we're going through that right now. For my daughter's FAFSA, they didn't look at last year's tax return. They looked at the year before, again, 2 years previous, essentially. So what these guys are saying is, look, just borrow, take the student loans, borrow, and then when she hits a senior or a graduate and graduates, then you just take your Roth and pay off the student loan, because your student loan will still be pretty low nonetheless, but certainly it'll help you to get, in terms of, it won't add to fuel the fire for your expected family contribution, which may or may not put you over the top when it comes to being able to get scholarships, low income, whatever it could be. The more income they see, the higher your expected family contribution is going to be, the less grants and scholarships are going to get, and the more loans you'll get. We don't like loans. We like grants and scholarships, or even a reduction in tuition nonetheless. So again, don't take money from your Roth IRA while your kid's in college. Wait till he or she graduates. Take those student loans out. Wait till he or she graduates, and then use the Roth to pay off that debt as return of principals, because that's tax and penalty free, the return of principal. So if you're going for financial aid, you want to keep your Roth hidden. Again, essentially, they see it. The Roth itself does not hurt your expected family contribution, is the distribution from the Roth. The asset itself shouldn't cause any issue for your financial aid application. Is the distribution from that asset that's a problem. But the child gets student loans, and then when the student will no longer apply for financial aid, then use your Roth to pay off those student loans. All right, so that's the four things about the Roth that I want to share with you. Now, I do want to close up this, and this will be the last of this book that we talked about. But at the end of the day, even with those four things, I still love the Roth, and you should too. I'm just going to share with you this last chapter, because this is how I said, this is the worst case scenario for Roth. And I'll just show you if I can get down here real quick. Here we go. All right. Is this the worst there is? So this is chapter 16 of the book, before I go into those four things about why the Roth doesn't do you any good for those reasons. Let's just say I've been able to convince you to go the route of the Roth IRA, and you understand for the reasons why the Roth is superior, which it absolutely is. There's just no debate about that at all. And you decide to take advantage. But situations change, and now you need some money. So what do? You simply call up your Roth provider and say, send me a check. The worst thing that's going to happen, my friends, is you'll own taxes and a 10% penalty on your gains. That's it. No taxes, no penalties on your principal, just your gains. Your contributions come back to you tax-free. For all the benefits the Roth is, this is the worst case scenario. I owe taxes and a 10% penalty on my gains. It's even more of a slam dunk if you ask me. You may wonder what the worst case scenario of a traditional IRA is taxes and a 10% penalty on the entire amount, entirety. Where Roth is just a tax and a 10% penalty on your gain. That's it. So just to wrap up this, I hope this whole series was able to convince you about the Roth IRA. Get the book. Just obviously I'm selling this book to you, and that's fine. You can get it for free. Go to heritagewealthplanning.com. You'll get the pop-up, and you can fill out the pop-up, and it'll give you the book, the PDF for free. If you have Kindle Unlimited, it's free. If you want to get the soft paperback, which I like, because you can highlight stuff, and there's 30 chapters, 30 charts in here. Go ahead and do that as well. Will be $5.99 on Amazon. But the Kindle version is $4.49. And if it doesn't save you that in taxes, I'm not going to give you a refund, but I'd be shocked. So understand the Roth. Do not just look over it like, I'm going to be in a similar or higher tax bracket in the future, so the Roth doesn't do me any good. No. Remember, the Roth not only does it avoid income tax in the future, it avoids higher taxes on Social Security, higher Medicare premiums, higher taxes on qualified dividends, long-term capital gains. It avoids the widow's tax trap because widows paid more in tax than couples. That's just a fact. It avoids higher taxes on your heirs. It avoids higher income taxes on your surviving spouse. There's so many things the Roth does. I go chapter by chapter by chapter. It's not a long book, my friends. It's 70 odd pages. Just get it and then look at the Roth, and I think you'll be pleasantly surprised what you find. So hope you like this. If you like what we do here, don't forget to subscribe. Thumbs up always help. The thumbs up tells the YouTube algorithm that this is informative stuff, and they share it with other people who are looking for like-minded topics. So I'd love a thumbs up from you, please. And then, of course, subscribe, hit the notification bell, and comments are always welcome. And then go to the blog at heritagewealthplanning.com for the podcast. And then I do the blog post I have. So we'll see you next time. Thanks, guys.